I started investing when I was 11. Looking back, I feel like I wasted those early years, just tinkering and doing nothing productive. Ages 7, 8 and 9, all gone. But when I was 11, I finally bought my first stock. And from there, I was hooked. I read every book about investing under the sun. At first, I went through all the typical phases. I tried charting. I tried timing the market. I looked at moving averages, technical patterns, basically all the gimmicks. It was exciting, sure, but profitable? Not at all. It was like playing a game with no scoreboard. Then in 1949, I picked up The Intelligent Investor by Benjamin Graham, and that's when everything changed. I'd never heard of Graham before, but 2 chapters in that book laid the foundation for everything I do today. They gave me a philosophy, a real structure to think about investing. There are 3 big lessons I got from the book, and make sure you stick it out to the very end of this video, because one of the lessons uses such powerful analogy, it genuinely blew me away. I promise it's one of those rare aha moments that shifts your whole perspective. You will see exactly what I mean. It's a real eye-opener, and believe it or not, they are so simple that most people often overlook them. But their simplicity is exactly what makes them so powerful. Lesson 1. A stock is a business. This sounds obvious now, but it wasn't back then. Not for me, and not for most investors. A stock isn't just a ticker symbol. It's a real business with real products, employees, competitors, and management. You're not buying a number that moves on the screen. You're buying a piece of a company. When I was a kid, I could name every ticker symbol on the New York Stock Exchange. T was AT&T, X was US Steel, but I had no idea what those businesses did. Once I started treating every stock as a piece of a business, everything changed. I began asking the right questions. What does this company do? How good is its management? What kind of economic moat does it have? Who are the competitors? What's the long-term outlook? That's when investing stops being a game and starts becoming a craft. Lesson 2. Don't listen to Mr. Market. This is my favorite concept from Graham. In chapter 8, he introduces a character called Mr. Market. He's your business partner, and every single day he comes to you with an offer. He'll either buy your shares or sell you his. But here's the thing, Mr. Market is emotionally unstable. He's either euphoric or depressed. He's drunk on optimism one day and drowning in despair the next. Imagine you own a gas station with someone who walked in every day, shouting wildly different prices to buy or sell half of the business. That's insane, right? Yet, that's how most people treat the stock market. The key is to ignore Mr. Market until it suits you. You don't owe him anything, but once in a while, he offers a deal so ridiculous, either too low or too high, that it would be foolish not to act. That's your moment. The rest of the time, just let him rant and rave. Lesson 3. Always demand a margin of safety. Let's say you're driving a truck that weighs 9,800 pounds. You see a bridge with a 10,000 pound limit. Do you cross it? Not if you're smart. You drive down the road and find a stronger bridge. Because signs wear out, weights shift, accidents happen. In investing, the same rules apply. Never bet the exact same limit of what you think something is worth. Leave a margin for error, for uncertainty, for the unknown. If you're not getting a big enough margin of safety, walk away. There are thousands of companies out there. You only need a few great ones. Now let's say if you were given $1 million and told you have 1 week to buy into 3 private businesses anywhere in your city. After that, no more buying, no more selling. You have to hold those businesses for life. What would you look for? You'd search for companies with an enduring competitive advantage, a moat. You'd want a business that can defend its profits from competitors year after year. Coca-Cola, for example, has a moat. 6 billion people know what Coke is. It's not just sugar and fizz. It's a brand, an experience, a feeling. RC Cola can spend $1 billion and still not come close to what Coke has built. That's what you want to own, and you want that business to be run by honest, capable people. Better yet, find a business so good that even a dope could run it. Because someday, one might. Finally, you need a sensible price. Even the best business in the world isn't worth buying at any price. When I invest, I often start by ignoring the stock price altogether. I read the company reports, understand the business, build a valuation, and only then do I check the stock price. That way, the market does not cloud my judgment. There are thousands of stocks out there. You don't have to play every day. If you only made 20 investments in your lifetime and they're good ones, you'll do just fine. In fact, I've told students, imagine we're given a punch card with 20 holes. Every investment you make punches a hole. Once you've used them up, that's it. No more. If you had that limitation, you'd think harder, you'd study longer, you'd wait for something that really screamed bargain. That's how you invest wisely. That's how you build real wealth. Not by following hype, not by chasing price targets, but by understanding businesses deeply, waiting patiently, and acting decisively when the odds are in your favor. That's what investing is all about. Thank you for watching. If you enjoyed this video and want to start investing in shares but don't quite have the cash flow, click on the video on the screen now. It'll give you a breakthrough way of going about your paycheck.